Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk.
Yeah.
Today, we're looking at Palantir.
If you find our talks useful, please consider subscribe, like, and comment underneath. So, to kick things off, what if I told you that the most important defense contractor in the world right now isn't actually building fighter jets?
Right.
Or tanks, or, hypersonic missiles. They're actually building corporate nervous systems.
Yeah, which sounds like science fiction, but it's happening right now.
Exactly. So today, we are looking at a company that is currently on just an absolutely explosive trajectory. I mean, they are fundamentally changing how governments and Fortune 500 companies operate.
They really are.
But, with that kind of explosion comes some truly extreme market expectations. So we're going to unpack their fundamental growth engine, map out the technical price action, and isolate the specific catalysts that could drive this stock over the next, say, 12 to 36 months.
Yeah, we really need to see if it truly is a category of one investment like everyone claims. And, to really grasp that category of one label, we have to understand the underlying business engine before we even glance at a stock chart. Because what is happening fundamentally right now is actively shocking Wall Street analysts.
Yeah, the numbers are just crazy.
The revenue acceleration we are seeing is wild, and it's driven almost entirely by the mass adoption of their artificial intelligence platform, or AIP.
Yeah, staggering is the word I'd use. Just looking at the fourth quarter of 2025, revenue hit just over $1.4 billion.
Yeah, $1.406 billion to be exact.
Right, and that is a 70% year-over-year growth rate.
Which is huge.
It's unheard of. For a company operating at this immense scale, growing top-line revenue at 70% is just, it doesn't happen.
No, it really doesn't.
And it's not just revenue either. It's flowing right down to the bottom line. Adjusted earnings per share came in at 25 cents.
Blowing past the consensus estimate, right?
Exactly. The estimate was just 18 cents. They crushed it.
Yeah, and that profitability metric is crucial, obviously. But to me, the true crown jewel buried in those earnings is their U.S. commercial revenue.
Oh, absolutely.
In that same fourth quarter, that specific commercial segment surged 137% year over year.
Wait, 137%?
Yeah, hitting $507 million. And the crazy thing is, this wasn't some, holiday-driven one-off spike.
Right, it's a trend.
Exactly. That growth rate actually accelerated in every single quarter of 2025. It started at 71% in Q1, and then it just relentlessly climbed quarter after quarter until it hit that 137% mark in Q4.
Wow. Which, that completely shatters the old bearish narrative.
Oh, entirely.
Because for years, the biggest critique was always, this company is just a glorified defense contractor.
Right, that they're too vulnerable to the political whims of government budgets.
Yes. But this commercial acceleration, it just obliterates that argument.
No.
And looking ahead to the 2026 guidance, management is projecting total revenue to land somewhere around $7.18 billion.
Yeah, which implies about 61% growth moving forward.
Which is just a massive sustained pace.
It is. And analysts are practically tripping over themselves trying to revise their models to catch up with that guidance. They've had to aggressively hike their 2026 earnings per share estimates by 30% just since the start of the year.
Bringing the target up to $1.31, right?
Yeah, exactly. But, the sheer size of these numbers kind of forces us to ask the foundational question.
Which is why?
Yeah. What is the actual moat protecting this growth?
Yeah.
Why are companies flocking to them instead of just using, generic AI models from other tech giants?
I think the best way to understand this moat is to look at the limitations of what everyone else is doing.
Okay, lay it out for us.
So right now, most generic horizontal AI models run on shared public cloud infrastructure. They are incredibly smart, right? They can write code, they can summarize massive documents.
Right, like ChatGPT or similar models.
Exactly. But they feel like a brain in a jar.
A brain in a jar. I like that.
Yeah, because they can answer questions, but they have no arms and no legs. They cannot actually do anything in the physical world.
Right, they just give you text back.
Exactly. But what this company has built, what they call their proprietary ontology, it acts like the central nervous system.
Okay.
It connects that smart brain directly to a company's hands and feet, allowing the AI to actually automate real-world operational workflows. It turns intelligence into physical action.
And that transition from intelligence to action is exactly what enterprise clients are paying a massive premium for.
Yeah, because it solves real problems.
Exactly. Think about a massive global logistics company. They don't just want a chatbot to summarize a PDF about supply chain delays.
Right, that's useless in a crisis.
Exactly. They want a system that instantly recognizes when a cargo ship is stuck in a canal, automatically calculates the financial impact, and then immediately reroutes global inventory to mitigate the loss.
Without a human ever having to push a button.
Precisely. Furthermore, this architecture allows clients to maintain absolute, strict data control within private clouds or even on-premises servers.
Which is non-negotiable if you are, say, the Department of Defense.
Oh, absolutely.
Or a massive global bank, or a major healthcare provider. You can't just dump highly classified military logistics or, protected patient health records into a public chatbot model.
No, that would be a disaster.
You need a system that maps the AI directly into your deeply complex, secure workflows.
And that deeply embedded nature is where that category of one moat truly crystallizes. It really all comes down to astronomical switching costs.
Right, because once it's in, it's in.
Exactly. Once this digital twin is built, once this software becomes the central nervous system connecting your factories, your human resources, your logistics, and your finance departments, it becomes nearly impossible to rip out.
Yeah, you aren't just uninstalling an app on your phone.
No, you would essentially be performing corporate brain surgery on your entire organization.
Wow, corporate brain surgery.
Yeah. Yeah. That level of operational integration creates a protective barrier that generic software competitors just simply cannot cross.
And that impossibility of ripping the software out is exactly what turns this business model into an absolute cash printing machine.
It really does.
Which leads us right into their financials, because a great narrative and a strong moat are wonderful, but as investors building wealth, you need to see how that translates to financial health and the stock's actual price action.
Exactly.
And right now, their balance sheet is a fortress. They are sitting on over $7.2 billion in cash and equivalents.
With practically zero liquidity risk.
Yeah, their current ratio is sitting at 7.1.
Meaning they have enough liquid assets to pay off all their short-term obligations 7 times over.
It's absurd.
It is. And in fiscal year 2025 alone, they generated roughly $2.27 billion in pure free cash flow.
Wow.
So this is no longer a cash-burning Silicon Valley startup trying to find its footing.
Right. Those days are long gone.
Yeah. And for a software company, hitting the rule of 40, where your revenue growth rate plus your profit margin equals at least 40%, that's the gold standard of financial health.
Yeah. To put that in perspective for you, hitting 40% gets you premium valuation status in the software sector.
Right.
Right now, this company's Rule of 40 score is sitting at an astonishing 127%.
It's just wild.
127%. When you combine that with gross margins hovering around 82%, they are vastly outperforming virtually every sector peer on the market.
Oh, without a doubt.
But, that $7.2 billion cash hoard raises a massive question.
Yeah, what do they do with it?
Exactly. What on earth are they going to do with all that cash? You don't just let $7 billion sit in a bank earning basic interest while you're trying to conquer the AI space.
No, you don't. And the prevailing market theory, and really the most logical move for their growth trajectory right now, is highly targeted mergers and acquisitions.
Okay, buying up the little guys.
Exactly. Specifically, Wall Street expects them to start acquiring smaller, specialized AI firms to aggressively boost their agentic AI capabilities.
And we should probably clarify what agentic AI actually means, because it's the next major frontier.
Go for it.
So agentic AI doesn't just generate text or answer a prompt. It acts as an independent agent. It can execute complex, multi-step processes completely on its own.
Right, it takes action.
Yeah. For example, instead of just telling you that you are low on a specific microchip, an agentic AI will check the inventory, automatically draft an email to your supplier in Taiwan, negotiate the shipping rate, and then update your internal accounting software.
All in the background.
Exactly. So by acquiring smaller companies that specialize in these autonomous agents, Palantir can plug that tech directly into their existing nervous system without having to build from scratch.
Yeah, and that kind of strategic acquisition power is what keeps institutional investors so engaged here. But, despite these pristine fundamentals, the stock chart hasn't just been a straight lineup.
No, it definitely hasn't.
We saw the stock hit a massive peak of nearly $208, but then the broader NASDAQ entered correction territory, triggering what we're calling the March washout.
Right. They weren't immune to the macro environment. The stock dropped about 17.5% year to date from that peak.
Which is a pretty steep drop.
Yeah, which, if you bought the absolute top, can be a really tough pill to swallow. But looking closely at the technical setup today, that pullback actually looks incredibly healthy.
Very healthy.
The stock is currently building a rock-solid new base right between the $128 and $146 levels.
And consolidation after a massive run is exactly what you want to see for long-term wealth building.
Exactly.
And the momentum shifting off those support levels is fascinating. We recently saw a highly bullish reversal, with the stock gaining over 14% in just 7 days.
Wow.
And crucially, that upward movement happened on heavy trading volume.
Which tells us everything we need to know. Because heavy volume means it's not just retail day traders pushing the price around on Robinhood.
No, not at all.
That is massive institutional money stepping in and aggressively accumulating shares ahead of the next earnings report.
Right. Institutions clearly view that 17% pullback as a prime buying opportunity. ARK Invest, for instance, has been doubling down heavily.
Oh yeah, they love it.
They've publicly stated they view this company as the absolute cornerstone of the physical AI movement.
Which brings us full circle back to your central nervous system analogy. AI interacting securely with the physical world is the ultimate endgame here.
It really is.
However, to maintain a truly clear-eyed investment thesis, we have to look at the other side of the trade.
Always.
We need to dissect the bear case. Because who is selling and what are the existential risks that could derail this momentum? Let's tackle the insider selling first, because that's the immediate red flag bears are always waving.
Yeah, that's a big talking point right now.
Over the past 3 months, insiders sold roughly $140 million worth of stock. Now, on the surface, that sounds alarming.
It sounds like a lot of money.
It is a lot of money. But from what I understand about executive compensation in high-growth tech, these sales are driven by 10b5-1 plans, which are completely automated, right?
Yes, exactly.
They are selling to pay massive tax bills and diversify their personal wealth, not because they are, quietly jumping ship.
Right, and that automated structure is the critical context that bears often conveniently leave out.
Yeah, they just post the big, scary number.
Exactly. Executives set these trading schedules months or even years in advance to comply with strict SEC regulations and avoid any accusations of insider trading.
Right.
The plan basically dictates that on a specific date, a specific number of shares will be sold, regardless of whether the stock is at an all-time high or in a massive slump.
Interesting.
So while $140 million is a large absolute number, it is very standard operational procedure for tech founders and executives, and it doesn't inherently signal a loss of confidence in the underlying business.
Okay, so the insider selling is largely structural noise. But let's look at a risk that is absolutely not noise: the valuation.
Yeah, the multiple is high.
This stock is currently trading at roughly 114 times forward earnings and 45 times forward sales. Morningstar just put out a note stating the company is trading at an 875% premium to their fair value estimate.
That's a massive premium.
I have to push back on the bullish narrative here. An 875% premium sounds like absolute market hallucination.
Yeah, it sounds crazy.
Can any company, no matter how good their operational nervous system is, realistically outgrow a premium that massive, or are we just totally detached from reality here?
Well, it's the single most important question for anyone allocating capital to this stock today. 114x forward earnings multiple is undeniably steep.
Very steep.
But this requires a deep understanding of how multiple compression actually works in hypergrowth scenarios.
Okay, explain that.
When a company is posting a 127% Rule of 40 score and projecting 61% top-line revenue growth, those sky-high valuation multiples shrink at an incredibly rapid pace.
Because the denominator gets bigger so fast.
Exactly. If you're growing your bottom-line earnings by 70 or 80% a year, what looks like a massive 114x multiple today will actually compress into a very reasonable bargain level multiple just 3 years from now.
Ah, I see.
They are quite literally growing into the valuation in real time.
That makes sense, assuming the growth doesn't suddenly hit a brick wall.
Right. That's the big assumption.
Which brings us to the next major risk: competition, because they are no longer the only game in town.
No, the space is heating up.
We are seeing incredibly powerful emerging agentic AI platforms from competitors like Anthropic with their Claude model and C3.ai, which recently launched its own aggressive enterprise AI platform. And in some recent utility tests, Claude actually scored incredibly high against them in raw coding generation.
The competitive landscape is absolutely getting more crowded, and models like Claude are brilliant at what they do. But this raises a vital distinction about where the actual economic value lies in the AI sector right now.
Okay.
Wedbush Securities recently addressed this exact competitive threat. They maintain their outperform rating and set a $230 price target.
Wow, $230.
Yeah, and their reasoning cuts right to the core of the issue. They noted that large language models, no matter how smart they get, do not replace the need for this company's software.
Because the large language model is just the raw engine. It
Exactly.
isn't the secure deployment layer. Generating a brilliant piece of code is one thing. Integrating that code securely across a highly classified global military network or a deeply fragmented corporate supply chain without leaking proprietary data is an entirely different challenge.
Entirely different.
That operational execution layer, the nervous system, is exponentially harder to replicate than a chatbot.
Exactly right. And the broader institutional market sentiment seems to firmly agree with that assessment. I mean, even with the undeniable valuation concerns and the rising tide of competitors, Citi just upgraded the stock to a buy.
Oh, did they?
Yeah, slapping a straight high $206 price target on it. The big money is betting heavily that they will remain the undisputed king of secure deployment.
All right, so we've weighed the pristine cash printing fundamentals against the very real valuation and competitive risks. Now let's look at the calendar.
The catalysts.
Yeah, what are the specific, tangible events, the upcoming catalysts that will act as the ultimate judge for whether this stock can reach those massive price targets over the next year?
Well, the most immediate hurdle is their upcoming earnings report on May 4th, 2026.
Okay, May 4th.
The consensus expects roughly $1.53 billion in revenue and 28 cents in adjusted EPS. A clean beat on that top-line number, specifically driven by sustained U.S. commercial growth, is the massive short-term catalyst the market demands to justify the current multiple.
Makes sense. They have to prove the growth is still accelerating.
Right. But beyond just waiting for quarterly reports, the real wealth-building indicators are the micro-catalysts happening every single week in their AIP boot camps.
Ah, yes, the boot camps. The boot camps are fascinating because they completely inverted the traditional enterprise sales model.
They really did.
Usually, selling enterprise software is an agonizing process. You're taking executives to expensive steak dinners, running through endless, glossy PowerPoint presentations, and arguing over IT budgets for, like, 18 months.
And that's all before a single piece of software is actually integrated.
Exactly. But they scrapped almost all of that. Now, they invite prospective clients into these boot camps, connect the software directly to the client's actual internal data, and solve a massive real-world business problem for them in a matter of days.
It's brilliant. It completely bypasses executive skepticism.
Yeah.
When a CEO can physically see their own messy, unstructured data suddenly transformed into an automated, cost-saving workflow in 48 hours, the budget gets approved immediately.
It's like trying to sell a hypercar, right?
Okay, I like this.
You can show a customer a brochure and talk about horsepower and torque all day long, or you can just put them in the driver's seat.
Yeah, let them drive it.
Exactly. Let them test drive it on a racetrack and let them feel the speed for themselves. Once an enterprise client actually experiences the velocity of this platform applied to their own operations, they physically cannot go back to their clunky legacy software.
No, they can't. And the conversion numbers prove that hypercar theory perfectly. They are achieving an astonishing 75% conversion rate from these boot camps.
Wait, 75%?
Yeah.
A 75% close rate in enterprise software is practically unheard of.
It really is. And we are seeing the massive public results of this strategy playing out right now. Lumen Technologies just publicly cited their new partnership with the software as a primary catalyst for their entire corporate turnaround.
Wow.
And Stellantis recently expanded their strategic partnership into a massive 5-year deal.
So the continuous stream of enterprise conversions acts as a constant micro-catalyst. But what about the macro picture? What are the global forces driving this adoption?
The macro catalysts might actually dwarf the commercial success, believe it or not. And it all revolves around global geopolitics and the urgent rise of sovereign AI.
Yeah, we've been hearing the phrase sovereign AI thrown around constantly, especially in the wake of the recent Hormuz crisis. What does that actually mean in practical terms for a nation state?
It means that global powers are waking up to a terrifying reality. They cannot rely on other countries or even multinational public tech conglomerates for their foundational artificial intelligence infrastructure.
Right, it's too risky.
Exactly. Just like a sovereign nation needs its own independent power grid, its own water supply, and its own military, it now recognizes the existential need for its own AI models.
Oh, that makes total sense.
These models must be trained exclusively on their own secure, sovereign data, totally isolated from foreign interference. The escalating geopolitical tension we saw during the Hormuz crisis has really turned this from a theoretical tech upgrade into an urgent matter of national security.
And when an allied nation-state suddenly realizes they need a highly secure, military-grade AI infrastructure deployed at a national scale in a matter of months, they don't call a startup.
No.
They call the company that has been building the operational nervous system for the U.S. defense and intelligence communities for the last 2 decades.
Precisely why they are so perfectly positioned to capture this macro shift. They're already partnering deeply with NVIDIA on major sovereign AI initiatives globally.
Oh, partnering with NVIDIA is huge.
It is. Furthermore, there is intense, persistent market chatter, currently unconfirmed but heavily rumored across defense circles, that they are positioned to be a major winner of the newly proposed $185 billion Golden Dome Defense Initiative.
Wait, 185 billion?
Yeah, if those massive macro defense budgets begin to unlock and flow towards sovereign AI infrastructure, the long-term upside is tremendous.
Okay, let's bring all of these threads together. We've covered the explosive 137% U.S. commercial growth, the fortress balance sheet generating billions in free cash flow, the 10b5-1 insider selling context, the extreme valuation multiple, and those massive macro defense catalysts.
We've covered a lot.
Give it to us straight. What is the final elevator pitch for an investor looking at this stock today?
Synthesizing all of these data points, we give this an 8 out of 10 bullish score.
8 out of 10.
Yeah. The core investment thesis is this. They are actively positioning themselves to be the definitive logic layer operating system for the entire AI era. They are uniquely capable of transforming chaotic, unstructured enterprise data into auditable, autonomous physical action.
Right.
Yes, you are paying a steep premium valuation today, but with elite Rule of 40 financial health and accelerating commercial adoption, they are rapidly growing into that multiple. We view this as a high-conviction, multi-year, think a 12 to 36-month horizon, with a very clear line of sight toward their target of $40 billion in annual revenue by the early 2030s. The recent technical pullback to the $128 base offers a highly strategic entry point for investors with a long-term wealth-building horizon.
A multi-year hold targeting $40 billion in revenue. That is an incredibly massive vision for the future of operational AI.
It is.
Which leaves us with one final provocative thought for you to ponder as we wrap up today. We've spent this entire time talking about the brilliant companies and the allied governments that are aggressively buying and deploying this software.
Right.
But if this truly becomes the foundational logic layer for the United States military and the Fortune 500, if it truly becomes the indispensable central nervous system of the modern automated economy, well, what happens to the massive enterprises and even the nations that don't adopt it?
That's the billion-dollar question.
Does lacking this operational nervous system make them structurally and economically obsolete in the next decade? It is something crucial to think about as you watch this space evolve. Thank you for joining Smart Wealth with Joshua.